corporate finance practice problem using OneNote. Payout ratio. Get ready, it's time to take our chance with corporate finance. Here we are in OneNote. If you have access to OneNote, would like to follow along, you're not required to, but if would like to, we're in the icon on the left-hand side in the Practice Problems tab, then down in the 1813 Payout Ratio tab. Also note, when using OneNote, look at the Immersive Reader tool. Our practice problems will also be down in the text area, same name, same number, but with transcripts that can be translated into multiple different languages and either listened to or read in them. Closing the icon, we have our information up top, calculation on down below in the blue area, looking at the payout ratio. When thinking about the payout ratio, we're thinking about, in essence, the net income, bottom line of the income statement or earnings, and how much of them we're going to be holding onto versus how much is going to be paid out in the form of dividends. This is going to be an important calculation, and it has to do with the equity section on, you could think of, in essence, the balance sheet or the accounting equation. Assets equal liabilities plus equity, or assets minus liabilities equals the equity section. In other words, equity representing the ownership of the corporation, the owners being the stockholders. Now, when you think about the equity section, we want to know what the relationship is when it's going to be increasing, and that's, of course, going to be having to do with the income in the company and how much of the income is going to be paid out. Also note, when you're thinking about the equity section in general, the equity section of a corporation is similar to the equity section of a sole proprietorship or a partnership. But when you then break it out, in essence, it's being assets minus liabilities equals equity representing the ownership share in the corporation, or the owner's claim to the assets versus liabilities or debtor's claim to the assets. But in a corporation, then we break it out a little bit differently. In a partnership, it's going to be broken out by basically who the partners are. We have to actually assign kind of an equity account to the partners. In a corporation, it of course is going to be broken out by the shares. Because the shares are all the same, in essence, that's the point of them being tradable, that allows us to break out the equity section a little bit different, and we're thinking about the equity section in terms of what has been invested into the company versus the earnings that have been retained in the companies. And so we're going to have those two major components within the equity section. There could be more involved in the equity section as well, but those are the two kind of categories that we will have. The retained earnings represents the earnings that have accumulated upwards, which have not yet been paid out in the form of dividends. And then, of course, we can take those numbers, since all the shares are the same, and start breaking them down into a per unit or per share type of basis. So that's the general idea. So when you're thinking about these type of relationships, you want to think about how to calculate the payout ratio and how to back into, say, the retained earnings and the increase in retained earnings and the equity section in general. And then we'll think about how to do that on a share by share basis as well. So the payout ratio, also note, is useful to have it represented in a percentage format, because that's useful for projections into the future, or trying to say what you predict to be happening in the future, to be paying out some percentage of the dividends, or how much percent of the dividends did they pay out. How much percent of the net income was paid out in dividends, and that can be used to project into the future. So let's see the payout ratio. We're going to say the earnings are going to be the $250,000. We'll imagine that in essence being the net income of the company. We're going to say that we retained. Now that doesn't mean retained earnings. It means that's the amount that was retained of the earnings. That's the amount that the retained earnings will increase by. But retained earnings being a balance sheet account, it already has a beginning balance and then would increase by this amount. And then we take the $250,000 minus the $190,000. That's going to give us our $60,000. That's the amount then that must be paid out in dividends. In other words, if we had earnings of the $250,000 and we retained $190,000 of it, we would have paid out the dividends of $60,000. You can, of course, think of that the other way. You might see a problem formatted in this format. It might say that the earnings were $250,000 and then give you the dividends, how much was paid out, and then you can figure out the change in retained earnings in that kind of situation as well. So you might see that too. We're going to compare then the dividends that were paid out to the earnings and of the $250,000 to get our payout ratio. Let's go ahead and plug that in the calculator just for the fun of it. We got the $60,000 divided by 250,000. That's going to give us our 24%. If we move the decimal 2 places over, it could also be useful to calculate it on the side here if you're doing this in Excel. So if I had the 250,000 earnings or net income minus the amount that was retained, in other words, not paid out, that gives us the dividend. Here's our 60,000. The 60,000 again divided by the 250,000 would give us the 24%. We can also think about the percent that was retained, which was the 190,000 divided by the 250,000. So that's going to be the 76, and of course the 76 plus the 24 is 100%. Let's do that again. 76 plus the 24 is going to be the 100% there. So then let's do it again. Let's say the earning, let's pretend here the earnings were 225,000 and we retained 90,000 of it. So if we were to calculate that in our formula, we're going to say they earned, in essence, net income. You can think about basically bottom line of the income statement, 225,000. We retained or did not pay out in the form of dividends, 90,000. Therefore, the dividends, 225 minus the 90, 135. Now, again, they might format this problem the other way. They might say, hey, there's the earnings, which you would probably, project, and then the dividends that are imagined to pay out, and then you could back in to the change in the earnings, the amount that will be retained, not retained earnings, but the change in the retained earnings. And then we're going to compare that to the earnings, and that'll give us our payout ratio once again, which is going to be the 225,000. I'm sorry, let's start with the top number first, 135,000, 135, and then I'll skip the zeros, 225. That's going to give us our 60%. And we could, of course, see this on this side as well, and we could see the breakout between the retained earnings divided by the 225, giving us the 40-60 breakout of the earnings. Now let's do it a slightly different variant on this. This time we have the earnings of 1,570,000 and the payout ratio at the 15%. So now we can think about the payout ratio calculation. We can calculate the dividends, and we can calculate the retained earnings or the addition to retained earnings. So note, again, a problem, of course, could imagine the scenario given in multiple different ways and use your algebra to back into any of the unknowns. You can use your algebra multiple ways, how you want to set up your tables to back into basically the unknown. But the important thing is that you understand the relationship between the earnings and the dividends and the amount that's going to be retained and so on. And then we want to picture what that's going to look like on the actual balance sheet. So you could think about this in terms of your ratios over here. So our payout ratio was the dividends divided by the earnings. We can also think of it as the earnings minus the retained funds, the amount that wasn't paid out. That would be the dividends divided by the earnings. And we can plug that into our formula here if we want to use this calculation and then solve for the unknown. So remember, if you have something like the payout ratio memorized, then you might want to use that formula and then just plug in the unknown and back into the unknown instead of trying to basically memorize a whole new formula. So there's different ways that you can kind of think about this in your mind. If you look at an answer in a book problem to this type of thing, it'll rework the formula solving for X, making you think that you have to memorize different formulas or not really telling you the relationship between the two formulas. And just realize, of course, you want to know the relationships between the formulas so that you can use the same formula and or see the relationships, how they're linked together, the linking of them together. Understanding that in your mind is the important thing to do. So if we were to plug it into an algebraic equation, we could plug this in. The payout ratio is going to be 15% equals, and then we've got the earnings minus the retained funds. The earnings are 1,570,000 minus X, the retained funds, the unknown, divided by the 1,570,000, which is the earnings again. So you could solve for that, solve for X. I'm not going to do it algebraically here. I'm going to do it with the table, so you can do the algebra on your own if you want to follow through with that method. Let's look at the table in the same format we saw before. Now, a table like this, sometimes if you have a fairly basic calculation, it's easy just to put it in a table. Sometimes it's easier than actually doing it algebraically here, and you can kind of back into the unknown just by looking at the table. If it's a complicated table, you can do this in Excel and use GoalSeek. But something like this, sometimes it's easier to just write down the formula as you might normally do it this way. Earnings, and then the amount that was retained would give us the dividends paid out. and then we would take that and divide by the earnings, or possibly even do that on the right-hand side here, and that would give us our payout ratio. And then plug in what you know, which is going to be the 1,570,000. We know that. We don't know the amount that's retained, and we wouldn't then know the amount of dividends to be paid out yet. And we do know the earnings down here, and we do know the 15% at the bottom. So then we can back into this number. This number would be the unknown, right? We could say, okay, well, I know whatever this is, whatever this divided by this is going to equal that. And if I didn't know what that 225 was there, then I can say, all right, well, what if I take the 1570000 times the 0.15? That can bring us up to this number. So sometimes this is a little bit easier to do actually than writing it out algebraically if you have a formula, like pretty small formula like this. And then you could say, all right, and once I have that number, then of course I have the earnings, and the earnings minus the retained earnings is the dividends. So if I didn't know what the earnings were, I can then take the 1570000 minus the 235,500, and that would give us, let me do that again. We can take, yeah, that's right. That's right. And that would give us the 1,334,500. So we can kind of back into it. And again, sometimes I think it's easier to if you visualize a formula this way and it's not too many numbers, like a cost of goods sold, I often think about that way. Then you can kind of format it, and then you can double check it nice and easily this way too, instead of plugging it back into a algebraic formula like 1570000 minus the 1,334,500 is going to give us the 235,500. Taking that, dividing it by 1570000 gives us our 15%. And if it was in Excel, you can do that same process in Excel, and then I would basically recalculate it on the right-hand side just to double check it once again. So the other way we can kind of look at this is I can say, okay, well, if I know the earnings and I know the payout ratio represents how much of the earnings we paid out in dividends. So we can use that and say, well, let's calculate the dividends then. That's pretty straightforward. We're going to say the earnings are the 1,570,000 times the payout ratio, how much we paid out in dividends, in other words. So the 1,570,000 times the 15% is the 235,500 paid out in dividends. And if we know the amount that's paid out in dividends, then we can find the amount that's going to be retained in retained earnings, because that's going to be the amount that we didn't pay out in dividends. Once again, this not being the ending balance in retained earnings on the balance sheet, but the change, the adjustment from one period to the next. It would have to be added to the beginning balance to end up with the ending balance on the balance sheet. So the earnings we say are 1,570,000. We then said the dividends calculated at the 235,500. That means that we have the total of the retained or addition in retained earnings, 1,334,500, which of course we figured up here kind of intuitively this way, and you can also do it algebraically. So also note that you might think about this way, or you might work with someone that sees it this way. They might say, well, look, if I paid out 15% in dividends, well, then that means that if I take 1 minus 0.15, we're keeping 85%. So I could take this same 1,570,000 times 85%, the amount that we didn't pay out, the amount that we retained, times 1,570,000, and that would once again get us to the retained amount of the 1,334,500. So it's important to kind of understand these relationships between, these items, and then again we'll start to think about how that will look on basically the balance sheet, how it would look in the equity section. The equity section often being one of the more confusing components of basically a balance sheet, because the terminology of the equity section can change from different types of entities, partnership, sole proprietorship, corporation, even though equity in total can be similar, and then the corporation could have other things that complicate the matter, like preferred stock and different types of so they could buy treasury stock and whatnot, and different ways of calculating the common stock can complicate things a bit. So it's worth some time to understand this relationship, and then we'll talk a little bit more on the equity section.